Hey everyone, today we're diving into how companies decide on the right financing tools to fuel their growth. Picture this, a company wants to make some big investments. The first question on the table is, how much money do we actually need from outside? Here's how it works. The management team looks at projected sales, figures out what new assets are needed, and checks how much cash they already have on hand. If the internal funds aren't enough, well, they'll need to bring in some external capital. But hold on, it's not that simple. Next, they check the financial markets to see what kind of terms they can get. If they can't secure the cash on good terms, they might tweak their plans to stay within budget. Once they know how much money they need, the next step is picking or even designing the financial instrument to raise it. This is really the core of the whole financing decision. The right choice gives the company the cash it needs at favorable terms. The wrong choice? Oh boy, that can lead to higher costs, unnecessary risk, or even a failure to raise the money. Remember, most businesses make money by being smart about how they use assets, not by finding clever ways to raise cash. Financing should support the strategy, not put it at risk. This is especially crucial for fast-growing companies where a risky financing move can backfire big time. Bottom line? Think of financing as the safety net for your business strategy, not a shortcut to save a few bucks. Now let's talk about the classic debt versus equity question. Imagine ABC Company needs $200 million this year. Should it issue bonds or sell stock? It sounds straightforward, but there's more than meets the eye. First off, bonds and stock are really just the extremes. There's a whole spectrum of financing options, and what we learn from the extremes generally applies to the others. Second, not all companies can issue stock. Smaller businesses often can't or won't go that route, which means the key question becomes, how much debt can we safely handle? For them, financing is part of a bigger, ongoing growth plan. Third, raising money isn't usually a one-time decision. ABC may need $200 million today, $150 million in 2 years, and who knows how much more in the future. Today's choice affects the company's ability to raise funds later. Quick tip: in finance, there's rarely one perfect answer, but there are plenty of wrong ones. This brings us to a major concept, OPM, or other people's money. Borrowing or raising external funds changes the risk and reward for owners. Along the way, you'll also deal with taxes, costs of too much debt, incentives and risks of high leverage, challenges for firms that can't issue new stock, and even how investors react when you announce financing plans. Wait a second. If you've gotten even a little aha moment, or if I made you grin, hit that subscribe button and smash that like button. Let's navigate this wild world of finance together. Okay, now let's talk about financial leverage. Basically a supercharged, double-edged sword. Think of a lever in physics. It lets you lift more weight, but requires more effort. In business, leverage, or using OPM, can increase the potential return for owners, but it also increases risk. Here's an example. Imagine an investment costs $10,000 and has a 50-50 chance of returning either $9,000 or $16,000 next year. If you finance it with all your own money, the return range for owners is roughly -10% to +60%, with an expected return of 25%. Now let's mix in some debt. Borrow $8,000 at 8% interest and only put in $2,000 of your own money. Suddenly, the potential return range jumps to -80% to 180%, with an expected return of 50%. Moral of the story? Debt can supercharge returns, but it also supercharges risk. Want low risk? Stick with equity. Feeling lucky? Mix in some debt. Feeling daring? Crank up the leverage. And it's not just about one investment. Companies can use leverage to create all sorts of risk-reward combinations, depending on how they finance themselves. Here's another way to see it. Leverage is like operating leverage. Swap hourly workers for a machine. Fixed costs go up, variable costs go down. You need higher sales to cover costs, but once you hit break-even, profits rise faster. Debt works similarly. Interest and principal are fixed costs, but profits beyond that go straight to the owners. Finally, let's look at return on equity. ROE measures how much profit owners get from their investment in the company. If the company earns more on its investments than it pays in interest, debt increases owner returns. If the company earns less than the borrowing cost, debt reduces returns. Leverage is like a fair-weather friend. When things go well, it makes you look amazing. When things go badly, it can magnify losses, sometimes by more than 3 times. Imagine a company with a 10% return on assets without debt. With no debt, the downside is small. Take on significant debt, and while the upside can be huge, the potential losses can be massive too. This shows why financial leverage is powerful, but risky. It can boost returns, but it can also magnify losses and even bankruptcy. Takeaway: debt is a tool, not a magic bullet. Use it wisely. Leverage is about balancing reward and risk and ensuring the company can survive if things go sideways. Smart growth comes from understanding your options, knowing your limits, and using debt strategically, not recklessly.